SpaceX is currently preparing for a $75 billion capital raise at a $1.75 trillion valuation. While public focus remains on rockets and satellites, the company's internal roadmap has pivoted to a role that has little to do with space. In its recent filings, SpaceX is positioning itself as a massive AI infrastructure landlord. It has already secured deals with Google and Anthropic worth an estimated $26 billion annually, renting out data center facilities designed to house hundreds of thousands of Nvidia GPUs. The sheer scale of this build-out is outstripping the cash reserves of even the largest tech firms. Major players like Meta and Oracle have raised $250 billion of debt globally this year alone to fund AI-related investments, signaling that the boom is now being driven by global credit markets. The AI economy has evolved into a capital circulation system, where chips become collateral, data centers become financial instruments, and the same money moves through model labs and hardware firms in a recursive loop. To see how this architecture functions, we can track the life cycle of a single dollar as it moves through this interconnected network. The cycle begins when a model lab receives that dollar as an equity investment from a major venture fund or a strategic tech partner. The lab immediately commits that dollar to rent compute capacity from a cloud provider or a specialized neo-cloud startup to train its next model. The cloud provider then takes that long-term rental contract to a bank to secure financing, using the loan to buy a high-performance cluster of Nvidia systems. The chipmaker recognizes that dollar as revenue, then takes a portion of its profits and places a strategic investment back into this same cloud provider that just bought its hardware. This entire loop is then presented to private credit markets. Lenders see the locked-in contracts and the rising valuations, and they provide the billions in debt required to build the physical data center campuses that house the chips. This creates a multiplier effect. That initial investment now appears on balance sheets simultaneously as venture equity, cloud revenue, hardware sales, and debt collateral. This recursive system only stays stable if every part of it moves in sync. But the various layers of the AI economy are running on different clocks. AI models move in weeks, and users can switch providers in seconds. However, the hardware itself moves in generations. The most valuable accelerators in the world can become second-tier collateral faster than traditional infrastructure investors are used to. Physical infrastructure moves even slower. Securing land, permits, and cooling systems takes years. Upgrading a massive regional power grid to handle the load of a machine cognition center can take decades. Debt moves on its own schedule. Interest must be paid regardless of whether the chips are fully utilized or if the model's performance has improved. Bond markets reprice risk whether or not a user is impressed by the latest chatbot demo. The structural tension of the boom is that the fastest layer of the system, consumer hype, is being used to justify massive, multi-decade investments in the slowest layers, like electrical utilities and heavy construction. This is not a fake boom. The chips, the data centers, and the massive industrial transition are all physically real. If the revenue from AI automation grows fast enough, this will be remembered as a transition as significant as electrification. The risk lies in claim density, the sheer number of loans, valuations, and utility commitments being stacked on each unit of future compute before that compute has proven it can produce a durable economic return. If AI cash flows grow slower than the capital stack assumes, the machine becomes fragile. The debt, the depreciation schedules, and the power bills remain fixed, even if the utilization of the GPUs begins to drop. This financial risk has already migrated into the broader economy. Pension funds and insurance portfolios seek yield in the private credit funds financing these data centers, while the massive electrical grid upgrades required to power them are often recovered through the monthly bills of local utility ratepayers. The most important question of the AI era isn't who builds the smartest model. It is who manages the risk when the financial claims on future intelligence finally meet the reality of the physical clock.